Hi, Greg Black again. Welcome to part 3 of our course. First of all, I want to thank all of you who have taken time to post the questions below. Please continue to do so. Whether it's what we talked about in course 1 or course 2, or obviously the material we're going to share in this next course, we've put a lot of time and effort into this course, and we're very appreciative to see the remarks and the comments that have been made. So, today's discussion is going to hinder on the issue of underperformance. And in fact, there's a worksheet that you can download at the bottom of the screen. This will help you through the process as we discuss the issues of underperformance. But the reality here is that most people, largely due to the things that we've discussed in the previous courses like fees and the myths of investing, are underperforming. Either the products they are in are not providing the return that they should, given what the portfolio manager said it would do. But remember, what I said last time, 80% of all actively managed portfolios typically underperform that benchmark. But also a lot of times people are not getting the rate of return that they need in order to achieve the things that they really want to do in their lifetime. You need to understand what your need is and how true that is. So what I'm going to do today is examine this a little bit further by first reminding ourselves what it is that most investors are looking for. When we reach retirement age, most of us just want a calm, active retirement, free from a lot of the emotions and free from a lot of the worry. At least that's what people are telling me a lot of the time. Yeah, they want to be informed, but they want to make sure that whatever the obstacle and whether that's inflation, market volatility, political unrest, or they may have already factored that they've already factored all those things into the plan. They want to make sure that they're not going to be duped and that they're going to get good advice. They want to make sure they're not going to be victims of a Ponzi scheme, and that they'll be able to understand when those promises are too good to be true. And then lastly, they want to be involved, but they don't want to be spending 8 hours a day studying their portfolio. So if that's you, if you're like that, then you're going to find this segment especially helpful, because what I'm going to do is start sharing with you some of the actual case studies that we've seen in our company. Now, the names have been changed to protect the innocent, but the stories are real. So the first one I want to get into, I call the company man. In most cities, there are 1 or 2 big employers that dominate the news. In Salt Lake City, we have a couple of them. New York City has many, Dallas, Texas, other areas, etc. Whenever I meet people who work for these types of big companies, it's not unusual that they will have 100% of their money in that company stock. They feel very loyal to that company, very thankful for the opportunities they've had, and in many cases, they've worked for them their entire life. The company has been a great blessing to them, and they have had some great returns. And so it's only logical to assume that that's going to continue into the future. In fact, some of them feel disloyal if they did not continue to invest with that company. Now, I'm not going to name the name, but I can vividly remember one of our companies that we had in Utah that throughout the 90s, its stock price was soaring. It seemed to have a bad year would be 20% growth. And I remember meeting with Mr. Company Man when he said to me, "I know you're going to tell me I need to diversify, but I don't want to hear it." And now that man, who's an engineer, thought that he was being logical. He was thinking with his brain, but in reality, there was a lot of emotion. And I hate to say it, but that emotion was showing itself in greed, as he felt that somehow he had found the magic secret to wealth. That he would always be getting 20% rates of return. Well, from that time that I met the gentleman, and when we got to March 2009, the stock had gone from an impressive $65 a share down to just $8 a share. Now, I don't know what happened to him from the day he left my office, but it was very clear that he wasn't looking to be coached. He knew what he wanted to do. He wasn't looking to get advice. And maybe in his mind, just feeling as if he needed to say something, or at least he could tell his wife that he had met with someone, that he was doing the right thing. But the problem here was obvious. With the decline, he was not getting the rate of return that he needed, largely because he was very emotional about what he wanted to do, emotionally wrapped up. I could contrast Mr. Company with Mr. and Mrs. Safety. Mr. and Mrs. Safety were very worried. They kept all of their money in very low risk and no risk investments, bank certificates of deposit, for example. They were very fearful of losing it all. Either they had been burned in the past, their parents had been burned, or their grandparents grew up during the Great Depression. I hear the story again and again and again, and what I'm told is like, I want my money to be safe, Greg. I'm not a high flyer. I don't want to take a lot of risk. I'm worried about how hard I've worked for it. I want to give it a rest. Well, the problem, of course, and we discussed this a little in the prior classes, that while you may think that it's a safe strategy, if you're not getting rates of return above what inflation and Uncle Sam are charging, then that is a high-risk proposition. You're really going what I like to call broke safely. Again, at 4%, just 4% inflation, prices will double 18 years. Just look at what food prices have gone to. So, while it may seem appealing, it may keep all of our money safe, in this instance, they were not doing that at all. They were actually, in my opinion, very big risk takers. The only way they were going to succeed is if they got interest rates that were high, and inflation was low, and taxes were low as well, and the odds of all three of those lining up, not very good. The likelihood for the success seemed very small. Another client I want to share with you, I'm going to call the Fosters. The Fosters are almost what you might call the typical family. They funded their 401k while they were working. They funded their IRAs. They seemed to be out of debt, but they were very fearful. They were a little worried that they might make a mistake at this point in the game. You know, when they were working, they didn't care that the markets did what they did. They went up, they went down, because a paycheck kept coming in. But now, they were looking to retire. And their concern was, am I going to make the mistakes? And am I going to make mistakes that are going to force me to have to go back to work? And that was something that the Fosters did not want. Now, the Fosters, what they needed to understand, though it was a rate of return, do they need their portfolio to get some type of return to be able to retire and have the lifestyle that they want? Also, we have to remove emotions. Fear can motivate us to do bad things. You saw the case before where fear was so great that the couple wouldn't get any rate of return practically on any of their investments. Greed, of course, is also problematic. As Mr. Company Man sadly found out, what we need to do is balance. We need a system that keeps our emotions in check. We can keep them in check over the short term, but it's usually over the long term that our humanity really kicks in. We need a system that when emotion shows up, we have checks and balances in place. So, do you have that? Or you have it now? And how are we going to do that? Well, the first thing that we want to do is get a clear understanding whether or not the returns we are getting are going to be adequate for us. Are we truly getting the returns that we're at least paying for? Now, the bottom line of this screen, we've put another worksheet for you to download. It's going to give you the instructions to find out if your current investments are at least doing what they tell you they are going to do. For example, we're going to show the benchmark of your funds and compare that to what your actual funds is. So the benchmark versus your funds, how are they lining up? This example that I'm going to use here is a company of funds that invest in large U.S. stocks. Now, funds may invest in other things too, The worksheet will help you determine what benchmark you should look for. But in this example here, imagine someone investing in a large US stock fund. And let's say the large US stock market is up 12% for a given year. If they're in a large US stock fund, at the very least, they should be producing a 12% rate of return. However, as we discussed last time, the majority of funds underperform their benchmark. In this case, if my fund was only producing a 10% rate of return, it sounds good, right? 10%. But the benchmark produced 12%. In my opinion, that's a loss of money. Yes, it grew 10%, but I paid that portfolio manager to produce above the average return. In this example, he didn't. How much is that going to cost me? Well, it all depends on how much you have. In this case, that 2% loss, which we call opportunity cost, times the value of my portfolio will determine how much money I actually lost, or did it, or didn't. But I should have made. We want to figure out what that relative loss was. So for example, if I have a $100,000 portfolio, that 2% difference translates into $2,000 loss. Now, you add that expense with the other expenses that we discussed in our last conversation, and you can suddenly start to see how this whole active management can be extremely, extremely expensive, and it can hurt your overall returns in your portfolio. The first step in the process is really getting an understanding about how what we have is performing compared to their benchmarks. The things that they told us that they were going to defeat. Are they doing it? So, what are the next steps? Well, first of all, in the examples that we saw previously, once I had an understanding about what they were doing, the first question I asked them was, how much income do you want? Now, surprisingly, a lot of people don't know the answer to that question. Now, one easy way to answer is to say, well, if you're still working, if your take-home pay is adequate, would your current take-home pay be sufficient? But I honestly ask everyone to take a clear inventory of what their expenses are and the type of retirement that they really want. Secondly, we have to determine, are you getting the return that you need to get? In the case of Mr. and Mrs. Safety, if they were perfectly happy and living on whatever their Social Security payments are, the fact that the rest of their money wasn't getting any real return wasn't a real problem. But if they said, you know what, Social Security is only going to give us about a fifth of what we need, and we want to get more money above that, then we have some work to do. We're not going to know that until we've answered the question about how much is that which we need. After that, then we can determine what mixes of assets and what's likely to give us the return that the least amount of risk and can be done without market timing and selective stock picking. Now, of course, this may require that you take on some additional volatility. And again, I've said the biggest obstacle out there are our own emotions. So, if a more diversified portfolio brings more risk to your life, if that's the cure, then are you willing to accept the cure? Can you handle the side effects of this medicine? It's important to be honest with yourself. I can tell you all day long to stay logical, but if there's no way you can, if you can't stay coachable, then maybe the answer is that you have to accept a lower income in your retirement. Freedom is above all about asking the right question. The 20 must-answer questions are a huge step in this direction. If you haven't completed them yet from Course 1, please take a minute to do that. I strongly recommend that you do. I also recommend that you understand that no matter how logical you think you are, and how smart you think that you are, in reality, none of us operate at an optimal manner at all times. I always think of golf in this example. If you look at the greatest golfers of recent years, clearly it is Tiger Woods would be up there. But what have we seen from Tiger Woods? He can't always perform at an optimal level. And that's why he's had multiple coaches. Before Tiger, Jack Nicklaus was the same way. No great athlete performs at optimal levels at all the time. And that's especially true when it comes into play for investors. I want to thank you for taking the time to listen to this. But I think you probably, and I know from this and the comments that have been mentioned below, that you're starting to understand that there's a lot more to this. That's why the worksheets help, and it's only a start. But a lot of times people ask me, where do we go from here? So how can I be better in tune? Can you guide me and help me so that I can overcome these obstacles and have the type of retirement that we've discussed here? Now, what I want to do is to just take a minute or two here and share with you how our process works. We always begin with the discussion. For me, to get a clear understanding about what's important to you and why. What have you tried to do in the past? What are you worried about? And what are you looking forward to and trying to accomplish going into the future? After that discussion, after I get a clear understanding about what your real issues are and what you want to do, the next step is that you and I together design a strategy. After we discuss a plan, and I don't just go back to my office and write in a big book and hand that over to you. See, you and I roll up our sleeves together and we get to talk about all of the issues that relate to personal finance. My job is to educate you. My job is to tell you the pros and the cons. My job is to prevent you from doing something that I think would be imprudent or foolish. Now, you may not always agree with what I suggest, but it is my job to give you objective advice as we go. After that, it's a matter of putting together the specific steps that you are going to take for you to decide on the strategy at hand and then begin to implement that process. But we're only getting started. While this may encompass 3 or 4 meetings to begin with, the real work gets done in months and years down the road. And that's where coaching comes into play for us. Coaching is an ongoing educational process with clients where we help them to not only understand the technical aspects of personal finance and the technical aspects of their portfolio, but we also want them to have a clear understanding about their emotions and the values and make sure that they are in tune with those and that they're making wise and prudent financial decisions. So I want to thank you for taking the time to listen to this course again. And if you have any additional questions, please ask them. Also at the bottom of the screen, if you would like to arrange a consultation with me, either on the phone or in person, I'd be happy to do that. Normally our rate is $200 an hour. But for those of you who are attending this course and have listened to it, we've waived that fee for the consultation. I will take the time to talk to you at no expense and get to know you and a feel for what or how we may be able to assist you. Thank you again, and I look forward to meeting you in the future.